The SME banking segment in Nigeria is facing new pressures from the central bank's regulation of commissions and new minimum rates for savings deposits. To discuss the impact of these new rules, I'm joined now by Jule Anele, who's head of retail banking at Diamond Bank. Jude, it's great to speak with you again. And I was just speaking to Riley about Diamond Bank's performance. So clearly, you know this business. You are very focused on retail banking. And I want to first of all get your thoughts on the impact of these changes that we've been hearing about in the banking spaces. Commissions on transactions have been slashed. Savings deposits have risen to a minimum of 3.6% on savings. So your thoughts on how the retail banking space is coping with these changes?
Yeah, thank you, Wale. It's actually very interesting. I will say clearly that this decision by the central bank, or shall I say the bankers committee, caught a lot of banks on the back foot. Reason being that in terms of revenues, most banks are already very constrained, and on the cost side, they find that it's now going up. So if you look at the savings rate, that was on average 2% per annum, it has inched up to 3.6, and which may also go up depending on how the MPR goes. That's monetary policy rate.
It's pegged to the MPR, yeah.
Absolutely, you know. So if the MPR goes up, it goes up. If it comes down, like we expect it to come down, inflation rate stays below 10%, single digit, then maybe banks can smile. But that means that the revenue base of banks is now very, very constrained, especially in the retail space. Of course, like you know, retail is known to mobilize low-cost deposit for banks. But you find that now it may not be as low cost as possible. The only area that retail can play in very actively now to maintain that low cost is in the current account space and no longer in the savings space. However, I would say that there's also a lot of value for customers. Okay, if you look at the inflation rate about 9% and savings rate at 2%, in real terms, people are actually losing money, saving money. Okay, so, but you know that most people actually are not saving, they are simply storing money. That's why a lot of people do not really care much about the savings rate. But I think there's a lot of value for customers inching up the savings rate and benchmarking it to MPR. I think is a key thing to do. But what we may witness is a slight increase in the lending rate. That may be the D-Jack reaction of banks. I was
just going to get to that. What impact is this likely to have on lending rates? Because clearly with the move by setting a higher savings rate, the cost of funds for banks automatically goes up. So it seems like they must be passing that additional cost to the borrowers in the form of higher lending rates.
Absolutely. You find that the central bank refrained from regulating the lending rates. They rather said, well, it's based on the risk of the customer. And of course, you know that with that side open, it's easy to pass on the increase in cost of funds to those that are coming to borrow. But away from that, even to the COT area, what you also find is that a lot of banks depend on this COT as a source of revenue. After interest income, you get COT before you get LC, that's letter of credit commission. So with that slash from 5 per mil to 3 per mil is a huge loss to banks. However, some banks have actually taken proactive steps even 4 years before now. I'll give you an example of Diamond Bank. In the MSME space, Diamond Bank's flagship product is called Diamond Business Express Account. That is not COT based. It's actually zero COT. And the reason we designed this product 4 years ago was in anticipation that one day COT will be a foregone revenue base or source for banks. And today we've seen it, by 2016, is zero COT for all current accounts. So I believe that some other banks like First Bank, I think Fidelity Bank have also followed suit in designing products for SMEs that are not COT based. So I think some banks actually did take some proactive steps to forestall any real shock to their revenue base if the CBN decided to take a decision like they've taken already.
Right, but very quickly, are any other commissions hit? We know the popular commissions on transactions on current accounts. You've explained that very clearly. But of course, there are other commissions that banks charge for buying FX and etc. So are there any other areas where the banks, if you like, have been hit?
Well, I'll say slightly. What CBN has done this time around is to bring some clarity to the guide to bank charges. The one that we had before April 1, 2013 has some ambiguities to it. So banks were allowed the flexibility to interpret it the way they wanted. So we found a lot of situations where customers complained bitterly in writing to central bank or to the bankers committee, and they've had to resolve myriad of these issues time and time again. So to prevent these issues and litigations arising out of these disputes, CBN has come on this time to be clear on each charge, but they also took the opportunity to slash some. So issues around processing fees, commitment fees for borrowers. You find that CBN has slashed it, say a maximum of 2% overall. And if you are going to charge a processing fee, it's one-off. If you are going to charge a restructuring fee for a facility, it is one-off. Some banks used to charge this over and over again, but CBN says it's one-off.
All right.
So, absolutely.
Okay, very quickly, if you can just give us some thoughts on this whole concept of de-risking the SME space. Of course, the central bank wants to see a lot more lending to small businesses. That growth hasn't been as aggressive or as strong as a lot of people would like to see. So, and of course, the banks continue to talk about the risks to lending to that space. Can you talk about the initiatives to improve, or should I say lower the risk to lending to SMEs right now?
Yeah, I think sometime past I've spoken to this before. Two key dimensions to this are two risks from the two sides. One, capacity risk from the small and medium-scale enterprises, and then capacity risk from the bankers themselves. First of all, on the SMEs, you find that the greatest challenge these SMEs face is not really cost of finance. It is cost of managing their businesses fully and very well, which includes the cost of managing the finance when they do get it. Now, the mortality of businesses is high. They say 5 or 1 in every 5 SMEs that start die in the first 5 years of the operations. And this is also very high, and banks avoid this. Working closely with IFC and Enterprise Development Center of the Lagos Business School, or Pan-African University as you know it, Diamond Bank has come up with an SME toolkit. And this toolkit is designed in such a way that uses it to build capacity for these small and medium-scale enterprises in such a way that the risk of their doing business is highly reduced. And what does that do for the bank? What it does for us is, because your risk is lower, we're able, on a risk-based lending basis, lend to you at a lower rate than we lend to somebody that has not passed through that process.
Right.
So that's why there's actually, as we speak today, since this week, some conference and seminar going on in partnership with Enterprise Development Center of Pan-African University and International Finance Corporation to build this toolkit and communicate it to customers. So.
Well, we certainly hope that it will work out and get a lot more money to the SMEs. Thank you so much, Jude. We have to leave it at Jule Anele is the head of retail banking at Diamond Bank.